So here we have exercise 718, which is the transfer of receivables with recourse. So when we are operating as a company, oftentimes we do business with clients and they may not be able to pay us immediately. However, we also have needs of our own, which are paying our employees. So therefore, what companies will do to raise money is that they will look at their balance sheet and they'll do things like, okay, cash is cash, but if I have an amount that's due to me, can I borrow against that amount? If I have inventory, can I borrow against the inventory? If I have property, plant, and equipment that's not being financed, can I borrow against that? And the answer is oftentimes you can, but you might not be meeting the most savory of characters. So let's take a look here at exercise 7-18. So Beyonce factors $175,000 of accounts receivable with Kathleen Battle on a with recourse basis. What this means is that if she factors them and they don't collect it, essentially Kathleen Battle can come back and get the money from Beyonce. So Kathleen Battle Financing will collect the receivables. They're transferred to Kathleen Battle and they assess a finance charge of 2% of the accounts receivable. And then there's a reserve of amount equal to 4% of the AR to cover for the probable adjustments. So what conditions must be met for a transfer of receivables with recourse to be accounted for as a sale? Your book mentions a few factors here, which is one, the transferred asset has been isolated from the transferor. And this is Beyonce. She's giving her accounts receivable to Kathleen Battle Financing. Kathleen Battle Financing, which is the transferee. Kathleen Battle Financing is going to be giving Beyonce money. Okay. So the transferred asset has been isolated by the transferor, basically put beyond the reach of the transferor and their creditors. Okay, so the transferees have obtained the right to pledge or to exchange either the transferred asset or beneficials' interest in the transferred assets. That's what they're doing, they're collecting it. The transferor does not maintain effective control over the transferred asset through an agreement to repurchase or redeem them before the maturity. So those are what it also has to do to be recorded as a sale. So let's take a look here in terms of saying like, okay, how much is Beyonce going to be receiving? Okay, so right over here, the amount of the accounts receivable is $175,000. So over here, the amount of the AR is $175,000. The receivables are transferred to Battle. Kathleen assesses a finance charge of 2%. And then there's going to be an allowance over here of 4%. And this is to cover basically in the event that some of them don't pay, this is basically going to be a reserve for adjustments. So the finance charge is going to be at 2% or $3,500. And then over here, the allowance is going to be at $7,000 or 4% of the 175. So the actual cash that is going to be received is going to be $164,500. So that's the amount that's actually going to be received. So when there is going to be a sale, essentially with recourse, This is going to be the entry we're going, if we are Beyonce, this is going to be the journal entry we're going to be making on August 15th. So we're receiving cash. The amount of cash we're going to be receiving is going to be $164,500. The other thing too is Beyonce is taking off $175,000 off the books. So we know that as well. In terms of this allowance in the event that the customers pay the full dollar amount, they should technically get back this allowance. So what we're going to say here is this is going to be due from the factor here of $7,000. Now, when we have a recourse liability, meaning that there is a instance where they would have to basically pay this back, we're going to go ahead and call this, and it tells us right here that the recourse obligation is a fair value of $2,000. So what's going to be the difference over here? Well, this is going to be a loss on sale of receivables. And what this is really going to be my plug, or what do I need to do to balance these accounts? And so what you're really going to see is that what is this amount going to be equal to? The loss on the sale of receivables is going to be the recourse liability plus the finance charge of $3,500. Okay, so when I add up this, when I put this in here as well, I should balance, which I do. So when we're looking at this over here, so what is happening is that Beyonce is selling the receivables. When she sells the receivables, she's going to get some money. She needs money. So I sold 175,000 of receivables. So how much cash am I going to get? Well, the amount of cash that you're going to be getting is going to be the amount of the receivable less the finance charge of 2%, less the allowance to cover any kind of, because they're not going to, if there's returns, allowances, or other things, this is going to be 4% of that amount. So the total amount of cash that Beyonce is actually receiving is going to be $164,500. So this is the cash that's received, right? So this is going to be the first number that you're going to want to go through and compute. The second one we're going to do is we need to take the AR off of our books. We're selling the accounts receivable. The next one we can do is we can say that this due from factor, this is the holdback. Okay, so right here is saying, well, look, I'm going to hold back this 4% in case you don't get paid, but if they actually pay me, I'm going to give it back to you. So this is what we call due from factor. The last part is essentially the recourse liability, or if I have to go through and pay this back, I'm giving this as a liability of $2,000. This is essentially like a guarantee. If my clients don't pay you, I'm going to make up for it. So the difference here, or this loss on sale of receivables, is really going to be the finance charge plus the recourse liability. And over here, we're going to call this to record the sale of receivables. Okay, so that is exercise 718. Thank you for joining me here today, and I look forward to seeing you on the very next video. Have a great one.